Good evening, everyone, and welcome to our live webinar, Q2 Market Outlook, entitled Trump 2.0. Basically, what we're trying to say here today is to give you some insights to how we would navigate this very difficult and challenging environment in light of what's happened under the new Trump administration. As you probably know by now, it has been a very, very noisy environment, so to speak, right? Without any pun intended, essentially, we've had lots and lots of information about Trump, the tit for tat in terms of the trade war, and obviously the impacts to markets, both on the equity, fixed income, as well as the alternate space. My job today as a CIO is to basically make these two gentlemen and the lady here a bit more difficult in terms of their views. But jokes aside, on my right here is Boon Ho, our head of fixed income. On my left here is Mabel, who's also head of equities for global equities. So without further ado, Mabel, I'm just gonna hit the question on the road, right? And that is that, there's been so many announcements on reciprocal tariffs, China retaliating, and so forth, right? And people are now sounding the alarm bells in terms of all of these tit for tat tariffs, right? So how do you see the current state of U.S. equities in this kind of environment?
I think U.S. equities are clearly in a vulnerable position because right now, this level of tariffs are unprecedented, right? And they keep ratcheting up every day. But the thing is, markets have also reacted very quickly. S&P 500 has fallen significantly since all these tariff announcements started. So we think it's quite difficult to actually predict what's going to happen to markets in the next 3 to 6 months because a lot of it depends on policy announcements. So what we've tried to do is to take a slightly longer term view. We looked at past crises. What has happened is, if you look back at COVID-19, the dot-com bubble, the GFC, markets crashed, of course, quite significantly. I think on average of 35%. But subsequent to that, in the next 1, 3, 5 years, we've seen very strong recoveries. So our view is that this is the time to be more disciplined. As the US market corrects, add to positions in quality names or in a broad-based index.
But you could argue that the market is already corrected about, or peak to drop about almost 20%.
Yes.
And one would say that basically, if history were to repeat itself, there's still more downside risk, right? Mm-hmm. So obviously, there must be some levels where investors should be thinking, if you want to think about longer term, then you should be thinking about it, right? So is there a view of how you navigate in this kind of very difficult? I know forecasting today is a very hazardous job, but we are trying to basically give our customers out there or clients out there some views on where we see how we should navigate in this kind of very difficult environment.
Yeah. So we have a sensitivity table in our recent second quarter outlook, whereby we estimate now the market is actually pricing in 0% earnings growth for the S&P 500.
Where was it before?
We started here at 13%. Mm-hmm. Along the way, it was cut to 9%. And now I think the market is not pricing in much at all.
Right.
At about 20 times PE.
So do you think at 20 times PE for a 0% earnings growth is reasonable, or is it too expensive, or how would you see that?
Yeah, it's not particularly cheap, but I think the US has proven that over the long term, it tends to add value, or like there's an upward trajectory in markets. So I think, to be fair, it is not cheap. It could go down further if bad news escalates. 16, 18 times has been the norm of the past.
Okay.
But I think what we're saying is we don't know when any of these policy U-turns could happen. So it's quite difficult to time the bottom of the market and therefore add to positions gradually.
Right. But do you see a ray of light in terms of potential catalysts? For example, maybe that would be a question for Boon Ho later on, but people are also talking about the Fed put, right? Which means the Fed could actually announce QE, or we talked about this before as well, right? That the Trump administration is also talking about tax cuts.
Right?
But are these kind of in the back burner, or are these kind of in front and center of people's minds today, that people are trying to anticipate this to actually extrapolate what should be S&P 500 going into 2020 in the end of 2025, right?
I think right now it's just panic. So everyone is just focused on tariffs and how bad this is going to escalate. But if both really spirals out of control and people start to cut all their estimate, the Fed come up rate cuts, quantitative easing. Tax cuts come back into the picture again later this year. And also, don't forget, they might also have some trade deals, right? Which hasn't really been spoken about much recently.
Right. Yeah. I mean, the recent announcement or the news flow from Japan is quite encouraging, right? And that led to recovery in Japanese stocks over the last 2 days, right? Shifting gears a bit to Boon Ho, I know you look mainly on developed markets, but I thought it'd be interesting to tap your mind about how you see this retaliatory kind of environment that we're in between US and China. Because obviously what we are seeing today is that we are in an environment on uncharted territory, to say the least, of a tit for tat. 1 minute someone says, I'm going to increase tariffs to China by 34%. Next minute, increase to 50%, and now with 104%. Where does this all end, and how does that, shape where you see global economics, or rather, how do you see growth going forward for the global economy?
I think it's clear now that US or Trump is actually targeting mainly China, and the rest of the world is probably, for the lack of better word, is probably collateral damage. But I think at some point of time, if you look beyond the noises you see now, which is very pessimistic, at some point of time, they have to come to the table and click, whether it's China, US, Europe, or any other country.
Yeah, but China is saying, look, I'm going to go all out, right? And I'm going to fight to the end.
Okay.
So how will one interpret an all out world?
Well, there's no precedent, I think. If it's all out, it can reach either. That's shocking to a lot of people. I mean, still 100% what are we looking at? But I think at some point of time, there's too much pain, both to the local economy and also the water-based US, and also, of course, to China, that they will need to come to the table to talk about it and come for voice. At this moment, of course, it's very pessimistic because, as you say, fight to the end. But I think that is not going to be sustainable.
Right, okay. So based on that view, I mean, essentially, there is no free lunch, as we call it in economics. When you have crazy amounts of tariffs, the consumer is going to be suffering, particularly in the US.
Yep.
So obviously there is going to be a drawdown in it. So people will consume less.
Sure.
Inflation should spike up, right? So how does that play into how you see the fixed income market, particularly when you think about US fixed income, which drives a lot of fixed income markets globally?
Okay, I think that is top of the mind questions of a lot of investors. But particularly, there is actually a divergent process. Inflation is one thing which, at the moment, market is very fixated, especially the bond market, because of the tariffs actually being moved up very rapidly, especially against China. So that is actually pushing up the bond yield and it's quite negative on the bond market. On the other hand, if you recall last week, we just had severe downtrend in yields when people are worried about the other conflicting factors, which is growth concern or even recession fear. So I think that means that the bond market will continue to be quite volatile with all these conflicting factors, and that will keep a lot of people, hopefully, who are calm enough to capture the opportunity. If they run into a panic mode, of course, they will sell into weakness, and that actually defeat the purpose for long-term. So I think the advice is to actually stay calm, don't panic. As long as you stay invested in quality bonds, I think that will get through this cycle.
So in terms of your in light of what's happened, right? Have you changed your strategy in the short term? I mean, what is the second quarter outlook for strategy for clients out there?
So basically, we are give more focus on investment grade because the credit spreads have actually expanded. I think it will continue to expand itself in this short term, next 3 to 6 months. So investment grade will expand less. That means the yields will go up less compared to the high. Because common sense, right? High yield will actually be more affected, which are the lower quality type insurers and companies, be more affected by tariffs and also fallout of all this slowdown in economic activities. So focus on quality, focus more on investment grade rather than high yield.
But that's something. But that's something that we at CIMB CI office has always been recommending. Hey, right?
Yeah.
So that there isn't really much of a change in outlook like. But what about duration? I mean, you've been saying for quite some time, please avoid the very long tenor, like anything above 10 years, right? And if I read the strategy, you're now recommending more of a 5 to 7 year, right? So is that where you want customers to be positioned in going forward?
Yeah, definitely. Because in the environment where yields are swinging up and down very quickly, you want to avoid the longer tenor ones, particularly those which are above 10 years, which can actually be quite damaging. If you look at the 30-year, the weekly movement itself, for instance, the US Treasury is about 7.5% down.
It's trading like a stock now, that's why.
Yeah. So if you compare to the 10-year, for instance, the US Treasury is only 2.5%, which is 1/3 the volatility compared to 30. So it's better to stay on, it's best to stay, I think 3 years to 7 years is the sweet spot we are looking at.
Okay, good. Right, shifting gear a little bit. So we talked a little bit about US, we talked a little bit about fixed income strategy. One of the big outliers in equity markets today, up until last Thursday, was the Chinese, especially on the Hong Kong flight, HSI, right? No surprise there. We call a tactical buy at the end of last year. It outperformed significantly, and it gave up all of its gains within a day. So, should clients still be thinking about buying into the Chinese equity market? What are the kind of things that you're thinking about when you think about the Chinese equity market?
I think the extent of these tariffs is way worse than what we had initially expected. And right now, it does look like US and China, neither party wants to back down. So they're both just going ahead and filing tariffs on each other. This is clearly very bad for uncertainty, clearly very bad economic impact if they continue down this path. So I think right now we are removing tactical buy. We are going back to our original neutral stance on China. We think one potential saving grace is that the government will stimulate the domestic economy to try to offset or cushion some of the tariffs, but that may not be enough to completely offset it. So in China now, I think there is more rush to kind of add to positions aggressively, but for clients who are looking to have exposure there, we would recommend buying domestic companies, quality domestic companies on dips, balance that out with some dividend yielders for stability, and to avoid exporters, which are in the line of fire of tariffs.
Right, okay. But previously, if I recall, right, we did mention that one of the biggest catalysts for the Hong Kong China market has been this evolution of DeepSeek, which happened a week just after Donald Trump was inaugurated, and behold, that has re-rated a lot of the e-commerce companies and the tech companies, and people have now started to question, for example, some of the bellwether companies in technology, US being more expensive and Hang Seng Tech being cheaper, right? Where do you see the value in terms of AI or technology in China today, and will that be something in people's radar or mindset in terms of how you see China going forward? Right.
Yeah. I think that will be a longer-term underlying growth driver for China. Now, I think there is more acceptance that China can be competitive in AI and maybe self-sufficient in technology. But for now, if you're looking at the short term, nobody's focused on that. Everyone's still looking at tariffs. But yes, over the longer term, I think DeepSeek and AI will come back to the picture.
Right, okay. Now, we've been talking about ASEAN for a while, and obviously, ASEAN has been a major beneficiary of China Plus One. Now, when you have all of these trade restrictions, trade barriers being put up, obviously the trade flows will get impeded. And so, are you still a believer in the China Plus One story, given what's happened? And how would that impact countries like Malaysia or Singapore, which are generally, open economies, so to speak? They have a very, vulnerable kind of exports, but at the same time also benefit with last 4 or 5 years. Has this business model changed for China Plus One?
I think people are starting to question it now, because ASEAN is basically caught in the crossfires of this, US-China trade war. So I guess the investment thesis is being challenged slightly. It remains to be seen if it's completely derailed. I don't think we know the answer to that for now. But what I would say about countries like Malaysia and Singapore particularly are that within the ASEAN context, these two countries are still quite defensive. So if you look at Malaysia, for example, we've got a lot of domestic liquidity. So even though foreign selling is quite persistent, we do have government-linked investment companies are cashed up and are able to invest in the local market. Valuations are, of course, very cheap.
When you say cheap, right? I just ran a Bloomberg number this afternoon. Interestingly enough, we're now trading at 12.7 for the Asian market, and we are even, I think, the average for the last 5 years is about 13.5 or something like that. And interestingly enough, even with a 6% earnings growth, assuming that number still remains, we are actually trading at close to where we were during COVID periods. Now, what am I missing here? Why is the market slowly being sold off so much like today?
Well, I think people are just generally taking money off the table and being very risky. Yeah. So if you're selling markets like the US and China, ASEAN is also getting hit the same. I think what we try to value at here is to say that, yes, sentiment is one thing. Sentiment is clearly very bad everywhere due to the uncertainty. But if you drill down to fundamentals, Malaysia has got good dividend yielding companies, very stable 5-6% yield. You might also want to selectively buy into some of the banks as a market proxy, or even construction names for cyclical upside. But these are all, of course, for longer term views. In the next 3 to 6 months, I think there's still a lot of uncertainty out there.
We've also got a market called Singapore, and for the audience out there, basically want to have high dividend yields and limited exposure, trade conflicts, and a very stable currency. Singapore has always been a harbor for safety. But having said that, if you look at it, the Singapore market has been, from a big outperformer up until last week, also was underperforming last 1 week. So it wasn't spared. Banks got sold off. The REITs got sold off. These are the preferred sectors that we used to still like. So for the benefit of customers out there, then what do we do now? Do we add more positions? Is there a ray of light in terms of this? Is there more value that we're seeing today?
We definitely see value for the longer term. So Singapore, in our view, is a safe haven. It is a more resilient market, but of course, it's not immune to this trade conflict as well. So as the market is being sold down, as you rightly pointed out, we think Sing dollar is stable, corporate governance is good, dividend yield is steady. So look to gradually add positions. I think it could be a safe harbor in all these times of uncertainty.
Right. Okay. So, ladies and gentlemen, you've heard the view on an equity space, both in US and China, as well in ASEAN, and in our local market in Malaysia as well. There is a sense of caution, obviously, in terms of equities. Fixed income is a bellwether for us to harbor in terms of constructing portfolios. But I also want to touch on an alternative, which is gold, which is widely recommended by us since the last 1 year. It's done very, very well. It hit a high of about 3,001 recently. So I'm going to direct that question now to Boon Ho, and that is that, given the fact that gold has been a safe haven trade for the last 6 months or 9 months, so to speak, right? A massive outperformer.
Yeah.
What is quite interesting, since last Thursday, we noticed that gold actually corrected in an environment where it's heightened tariff issues, so forth, right? Is there something to read through about this, or is this an opportunity that I should take advantage of and say, look, if I missed out on the gold rally, this is time to go for the gold rush now, right?
So basically, gold still has the attribute good hedge this type of market because it benefits from high inflation, which is what people are fearful about from tariffs, and also things like, recession. So if recession come to play, this will be a good hedge against inflation. So I think this pullback is a good opportunity for clients to add position. And we have a target. CIMB Treasury has a target of 3.2 to 5 for gold, which it's based on current level is about 7% for current. So I think the message essentially, we should maybe allocate some exposure to gold as a good hedge against current market.
Right. Okay. I wanted to draw back a little bit on fixed income one more time. I think you missed out on the different markets that you like as well.
Yeah.
I want to spend a bit more time talking about that.
Sure.
Because I think it's important that for audiences out there to know that the fixed income market is not just driven by US Treasury, right? There are opportunities in Aussie dollar. There are also opportunities, for example, in sterling bonds and so forth, right? So maybe you can touch on the different segments of the market, and maybe also touch on maybe, for example, like the Malaysian bond market, for example, as well.
Oh, good point. Good.
Yeah. So is there any area that you should think that customers should not be thinking about investing in the fixed income world?
Should not.
Yeah.
Okay. So basically,
And then we talk about where you want to invest it.
yeah. So basically, what to avoid is, of course, the ultra long funds, which is the 30-year US Treasury, which I mentioned earlier. Maybe. And I think if there's opportunity for exit, you should try and find a client should find opportunity to actually sell, hopefully at position of slight gain, hopefully quite a gain. But of course, that will have to wait for market to rebound. So that may take 3 to 6 months time. But current market condition is not actually good to exit, especially when yields backed up so fast, few weeks. So what markets we like, as you mentioned earlier, Patrick, is Aussie dollar, still a good market that we think is good for the longer term. 1 year investment term horizon, we're looking at yields maybe close to 6%, 5.5%. And the other market we like is the sterling pound and US dollar. And Malaysia held a very good stability factor, because Malaysia, there's two factors which anchor the stability. One is, of course, the OPR rates tend to be very stable. I think we are expecting 25 basis points cut. That's our CIMB Treasury view, but that's very minimal compared to US 100 basis points, for instance, what practice. So that stability provide cushioned volatility in the market, much less. And the other factor is, of course, there's consistent buying support from the institutional investors, especially for PF and other. So that cushion the big fall. So Malaysia bonds tend to, although not very high yield compared to the rest of the world, but it provides safety and so safe harbor for low volatility, which I think is probably going to be much treasured by clients in this type of market conditions.
Right. All right. I'm going to ask my favorite question as usual, and that is a 30-second high-level pitch to our clients out there.
Sure.
And that is, what keeps you up awake the next 3 months? And what are the opportunities that you really think that customers should think about today, that you should think about investing?
Okay. My turn?
Yes.
Okay. So basically,
I think benefit of doubt.
So I think the best value are those which are actually quite at the borders investment grade, i.e. the triple Bs, corporate bonds, which can do maybe even 7-8% because of the severe sell down, the indiscriminate sell down. So we should collect some Aussie dollar bonds, cost fully for 1 year, 2 years.
Okay. What keeps you awake these days?
I think the fear of inflation from these tariff hikes actually can have a runaway yield, which so that is what can be worrying for investors. But looking beyond the noise, I think if there's too much yield volatility, the Fed, again, echoing what Mabel said earlier, the Fed will need to step in. And when they step in, I think that will provide some stability and support the bond market.
Okay, Mabel.
Keeps me awake. Every time I wake up in the morning, I look at the news and I see higher and higher tariffs, and I just don't know how they're going to reciprocate against each other. It's gone to the point where it's actually very difficult to make any meaningful analysis, because you never know when a trade deal comes. You never know when the tariffs could ratchet out even further. So
obviously that causes volatility, right?
So much volatility.
Yeah, but beyond that volatility, where do you see the opportunity?
So I think for me, I'm a believer that over the long term, US exceptionalism will prevail. Like, companies in the US have economic moats. They will somehow power through this. Okay, in the near term, I think it's anybody's guess when the market will bottom. But in this weakness, I would be adding positions in US indices or specific US market leaders.
Right, okay. You heard it from the experts here, ladies and gentlemen. Effectively, from the CIO's office point of view, in our second quarter outlook, our view is a more balanced outlook, right? We are cognizant of the risk. Obviously, there's a lot of moving parts to this landscape that we're looking at. But essentially, the message that I want you to take away from today's session is the following. Number one, I think in a world where volatility is very high, the obvious solution to your portfolios or your wealth is to anchor it with income. And income does not generally just mean fixed income. It also means dividend income portfolios. It also means portfolios with equities with a call option income as well, which we wrote about in our 2024 outlook. That's point number one. Income basically stabilizes your portfolio. Number two, if you are willing to take some risk, I would suggest that you think about portfolios which are more diversified than ever before. We have suggested before, and we continue to reiterate call that a global diversified portfolio is better than a narrower market because you get the best of both worlds. For example, you buy a global portfolio, you don't just own a US market, you also own other G7 countries like Japan, like India, all the kind of countries that we like, for example, which are long-term in nature, have very, very strong growth drivers, so forth, right? So you couple that with a growth and income barbell strategy, I think you can navigate a lot of volatility. Now, having said that, I do think that you also need to be, do the usual adage of dollar cost averaging as we go down, because no one really knows what's going to happen tomorrow in terms of what Donald Trump's going to say, because as you know, he tweets a lot, he shakes his head a lot, but at the same time, it confuses a lot of people. But beyond all of that noise, what we're trying to say here today is that given the kind of volatility we're seeing, there are obviously going to be, at some point, a ray of light. I'm not saying that it's going to be tomorrow. I'm just saying over time, markets should bottom, both in the equity and fixed income space. So on that note, we just published our Q2 outlook. It is in our website. Please go to our website and or maybe get it from your RMs. I want to end this session on a note that given how difficult investments have been in the last couple of weeks, I do want to reassure you here that the CIMB CR office is here for you. We're here to serve you. We're here to basically advise you on the best of the knowledge that we have in terms of the best alternatives or the best investments out there. So thank you very much for your time, and I hope you enjoyed this session. Till the next one, have a very good evening.